Most banks advertise how quick and easy it is to get a loan through them, but usually this couldn't be further from the truth. To shorten this process, it is extremely important to come prepared. Today's guests share some insight on what the banks look for. Brandon Hinkle is the CEO of PluraFinancial.com, a free online matchmaker between banks and small businesses seeking commercial loans. Great to see you.
Thanks for having me, JJ.
Okay, so you go into a bank, you kind of maybe have one shot, maybe two shots with these people. You want to have all your guns loaded, basically ready to fire. And the first thing you talk about is the thing everyone says: cash flow.
The number one most important thing that banks use when considering if a business is creditworthy is cash flow. And nerds like me describe that as EBITDA. It's earnings before interest, taxes, depreciation, amortization. It's basically the pool of cash available to service the debt. And banks want to make sure that a company has more money going into the business than out of the business. Generally, they want 25% more after giving effect to the loan.
Jim Blassingame, who has had a small business for years, runs a radio show, said to me that a banker said to him, if you bring in one document, just one document, that's what I want to see.
Exactly.
That's all you need. Okay. Next, collateral. I mean, a lot of small businesses don't have collateral. So.
That's right. But it's something that banks only get about 1% profit for small business loans. So they don't get a big reward, so they can't take a big risk. And they have to look at it and say, what if the worst case scenario happens and the company doesn't have enough cash flow to repay the debt? What can we do then? What can we rely on? And then they can rely on liquidating the assets of the company. So, for example, if somebody has a $1 million property that they purchased, the bank says, all right, in 90 days, I could sell this for $800,000. So that's the loan amount I'm going to give them to make sure that there's usually enough liquidated value of the collateral to equal the loan amount.
And does all of this collateral have to be in the business, or can some of it be personal?
It can be personal for sure. In fact, there's something called liquid collateral, which is the best kind of collateral for the bank. It's, let's say you have cash at the bank and you say, if I don't pay my loan, you can go after the cash I have in your bank, and that's great collateral for them.
All right, so that gets to the next point of the personal guarantee, which nobody wants to sign.
Nobody wants to sign, but it's very important, because what I say is, if you don't stand behind your business, why should the bank, right? And a lot of people have this fear that if you know, that my assets are going to be liquidated personally, but really, I've never seen, I was in a workout group, I have never seen yet a bank go in and liquidate somebody's, you know, entire pool of personal assets. Really, all it does is it aligns your interest with the bank's interest of getting the loan paid on time.
Is there any way to limit that personal guarantee, though? You know, maybe say at some point, if we reach this much in revenue or this much profit, then you will narrow my personal guarantee or get rid of it?
It is possible. With the SBA loans, they always have a personal guarantee, but especially as the business can stand on its own, as you get bigger, you can limit the guarantee. It's called a limited personal guarantee, and usually it's up to the loan amount. You know, a bank can be oversecured, so there's definitely limitations that you can put in place. But for a small business loan, especially an SBA loan, it's usually a full personal guarantee. Okay,
and then you as a person, we're talking about numbers and things. Now we're talking about you as a person. Ultimately, hopefully, you're dealing with a banker who believes in you.
JJ, people want, especially banks, want to know that they're dealing with somebody that's financially responsible and finds a way to get loans paid on time. So they'll look at your credit reports and they'll say, does this person have a track record of paying things on time? So, for example, if somebody has bankruptcy, it's usually a deal killer because, again, they want to figure out, have they figured out a way to pay on time? Because bankruptcy usually means they figured out a way to not pay a bill.
Right, and then last, equity.
Equity is basically the difference between your assets and your liabilities, and that's important for banks because they say, if we liquidated the business today, is there anything left over? And that's important for them.
All right, Brandon, thank you so much. A quick primer, what to take when you're going into a bank.
Thanks so much for having me.